Time we decided to talk a little bit about the language of the financial markets because usually what they speak, these markets, and what the symbols speak to tell us is a very interesting thing and very important in terms of trading operations, in terms of trading, and whether it's a gold market or an oil market, just a foreign exchange market, it does matter. Usually financial markets have their own language, and what they speak to us is what's behind those bars, those charts. That technical analysis of ours that is usually conducted before we take some decisions, some important decisions of buying or selling a specific asset. Here on the graph you see just curves of various things. Blue is oil, green S&P 500, red is gold, euro is some sort of a lila or something, well, and the other colors. It's really difficult to tell what are the colors, but still this is just what they look like. This is an everyday graph from April the 30th to May the 21st. This is usually, it differs of course. It may be a weekly chart, maybe an hourly chart. We know that there are many charts of course, and usually we use 5-minute charts, 15-minute charts, an hour chart, a 4-hour chart, and a daily chart also. They tell us lots of things. We try to develop a sort of a strategy for the next week, for the next day, for the next few hours of trading operations. But this is how they look like, for example, if we consider only the closing price for any specific moment, then they look like a single curve, with no bars, with no shadows, with no bodies. But now we know that in order to trade, you got to understand that there is an opening price, a closing price, minimum and maximum price at any particular moment. And each of these moments, whether it's a 5-minute moment, an hourly moment, or a daily moment, they all have that kind of graph. So each of these candles, this is the same thing actually. It is the same thing just like this one, only the difference is that now these bars tell us what is the closing price, what is the maximum, minimum, and opening price on every specific moment, depending on the specific asset and, of course, daily operations and the minutes or a particular moment, the duration of the period we consider. In order to understand what is behind these symbols, whether black, whether white, or on investing.com we got used to greens and reds of these things. Classically, a classical representation, because it started in the days when there were no colorful pictures, of course. These candlestick analysis started in Japan. That's why it's called candlestick analysis, Japanese candlestick analysis. There are many methods actually to understand the workings of the markets. There are various charts. But candlestick analysis is considered one of the most useful, and it speaks, like I said, its own language. It has specific symbols, and especially it's what about these candle combinations that is very important for us to understand. And that's why it's called candlestick analysis. Technical analysis is a general method of understanding the workings of financial markets. Candlestick analysis is just one of those instruments. It is just one of the instruments, because you can find the fundamental analysis. It is also candlestick analysis, figure analysis. Some try to look through the figures in the markets to understand where the market is going to move the next day, the next hour, the next 5 minutes. I also mentioned a few things to you last time about candles and how they look. Each candle consists of a body. It can be black or white in this particular case, or red and green at investing.com. Each of these candles has shadows, these little things that go up and down from the body, and they're called shadows. In both of the situations, whether it's black or white, they are the same, yeah? High maximum price and low, the lowest price at the particular moment. On an hourly chart, this is going to be on an hourly basis. Yeah? If it's a daily chart, then that means the lowest price at this particular day and the maximum price when the exchange closed, finished its workings. However, there are two types of these candles, and one of them is bearish and the other is called bullish. The bears drive the markets up and the bears drive them down. That's why bearish candles open the day with a closing price. Yeah, the body begins with the closing price, and if in order to understand why it's black and white, because you do not know during the day what kind of a candle you're going to get by the end of the day, because everything moves in the process, right? And you do not know now at the opening session whether it's going to be black or white. And only by the end of the day you will see that it's bearish or a bullish candle. If it paints white, that means that the asset finished the day with a higher price than the price at which it opened. You understand? So that means the price of the asset was higher that day than in the beginning of the session. And the candle turns black if the market closes at a lower price than it opened in the morning. And that's why they say that it's a bearish candle, bearish day for us today. That was a bearish day for us today, because the bears drove the market down. It is also very important to understand other symbols behind these bars and candles. There are various candles, and they have their specific names. And this is the point where this language comes about. For example, a candle with no upper shadow and a very small body, this is a very important thing. The body of this candle should be twice as less as the lower shadow. If the body is too big but has no shadow up, no upper shadow, it has a shadow, a lower shadow, it does not mean that this is a hammer. It can be both black and white. That means it can be bearish and bullish. But the main idea of it, the main characteristic of this candle is the same. And I will show you on the graph what it says. If such a candle appears at the lowest point of the graph, for example, here, you see, so we've got this downward slide, yeah? We've got a downward slide on this chart, and if such a candle with a very low, with a very small body, but a very low shadow appears at this particular moment, it is called a hammer. Why is it called a hammer? It is a sort of a signal that the next day is going to be the beginning of a upward drive in the markets. You understand? So it's as if someone struck a hammer and there was a huge, a sort of a big bang in the markets, and they recovered and started going up. That's why this candle is called a hammer. You strike as if you are a god Thor. You strike the market and it goes up at this particular moment. If it appears, if the same candle appears on the top of the graph, for example here, or here on the top of the graph, if it appears, for example, here, it has a different name. It is called a hanging man. Hanging man. And what it says, this hanging man, it says that the market is as if the market hanged itself. It means the death of the market, and the market is going to go down. Well, actually, it's the same kind of a candle, this one, only it is called a hanging man. It also can be a white or black, bearish or bullish candle. So now you've got two signals. If you see at the end of the day a candle such as this, and it appears at the lower point of the graph, then next day you may expect an upward trend in the market. If you are at the top of the chart and this candle appears, then next day you may expect a drop in the markets. And you got to take your decisions already. Of course, sometimes nothing happens, and people just make decisions that sometimes come wrong. Even professional traders make mistakes. And for example, I personally know a trader, a very experienced trader, he does the trading for a quarter of a century, for 25 years. And he started his trading activities back in the early 1990s, when we had no financial markets in the real sense of the word, so to speak, no forex markets. Well, we had something of the sort, but it was a very a Wild West thing, so to speak, because the Soviet Union only collapsed a few years ago, and we had in the Soviet Union foreign exchange. It was actually a crime to have a foreign currency at your home, and you could serve a prison sentence for that. Next come these kinds of candles. What is most important? Well, this one, the second, 4 or 5 spinning tops. It is a very rare thing, and usually they usually do not say anything. It is really difficult to understand what they mean. But this one, this is a reverse version of a hammer or a hangman. It has an upper shadow and no lower shadow, that means. And the name for this candle is a star or a falling star. Usually it is called the falling star because it's as if it's a comet which has a tail behind it, and it falls, and it symbolizes what I think you may guess. It is going to symbolize a fall in the market. So, for example, if such a candle appears somewhere at the top here, it's a sort of a comet that shows that next day is going to be a crash in the market because it falls. It's a comet that brings the message for the next day's trading operations, and you got to take your decisions. If it appears here, somewhere here, it does not say anything. The market may go down further, but this kind of a candle is not going to be called a falling star. It is called falling star only if you are at the top of the graph, at the top of the chart. Then it's going to be a falling star. Then we have a very funny candles with no bodies. What does it mean, no body? That means the day started and ended, finished, at the same price. The closing price and the opening price of this particular day are the same. They equal to each other. And we immediately get such a thing which is called, Japanese call it doji or doji. In English, they cannot pronounce it like Chinese or Japanese. It's a doji, something of the sort, but because they cannot pronounce it, they spell it like D-O-J-I and call it doji. Sometimes it is also a doji star because it looks like a star, a sort of a cross somewhere in the skyline. Dragonfly, also this is the same kind of a doji with no body at all, and actually it symbolizes something. If you've got an upper shadow, it's called a gravestone. And this is something very close to a falling star. And it says also the death of the market. It means it's a sort of for example, the market was driving up and up and up, and suddenly there comes this sort of a message, and that means the market will die. It's a gravestone. A rickshaw, it's a candle, a doji candle, with equal shadows. Upper and lower shadows must be equal. And then this candle is called a rickshaw. Rickshaw, as you know, this is a sort of a vehicle in India or in Bangladesh. They used to drive, it is driven by a human being, yeah? And there's rickshaw carriage, rickshaw vehicle. And you sit there behind the back of this rickshaw man. Usually it's a man, not a woman. And you're driving through the city of Shanghai or Mumbai, something of the sort. It's a very romantic thing because it comes way from the 18th century or 17th century, and you may see that kind of a vehicle in movies about British Empire in India, when India was a colony of Great Britain, with those rajas, those special clothes, and the special atmosphere in the cities. Then, what is also very important in the candlestick analysis is understanding the combinations of candles, because they also say their own language. They also have their specific message. If these three candles look like this, the candle that is in the middle can be a dodgy star, so a candle with no body at all. It can be also a small-bodied star, black or white, with long shadows, with long up and lower shadows. So here it's just an example. You must understand that the markets work in very unexpected ways, and these candles may look a bit different. But the thing is that the first and the third candle should look like this. They have usually long bodies, and the candle that comes in between is usually very small, and it is a star itself. So these two candles, the first and the third, they are not the stars, because the star looks a bit differently. But why it's called evening star? What is happening in the evening? The sun sets, and this is the specific message of this candle combination. That evening means that next day may be what? A downward slide in the market. That means it's just like a falling star. And what is the opposite? It is a morning star. It's when the sun rises, and the market is going to rise with it. But the difference is that this candle in between of these two candles should come lower at the lower end, yeah? So it should come lower. Sometimes it even breaks away down lower from these two candles, and in this particular case, this three candle combination is called abandoned baby. So it is something of the sort as if somebody dropped this baby, for example, after an abortion, or some sort of a desperate woman just dropped a basket with this child at the doorstep of some institution or home and left it there. Abandoned baby. So the market in this particular, the three candle combination is called abandoned baby. It should actually, so that means there must be a specific gap between them. Yeah? It's as if really somebody dropped it. It's like a drop of a blood before something. And that sort of thing should appear where? it appears at the same place where hammer appeared in the first example. That means at the lower case of the market, somewhere in the beginning of next day's drive up. So that means a morning star is the message that next day is going to be a bright day for us, and it's going to drive the markets up. And an evening star means that next day will be a drop in the market, and maybe even several days of downward trend. You see? So this is an example of a reverse dodgy abandoned baby in the opposite direction. Yeah, it also may go upper, and it is also called an abandoned baby, and there must be a specific gap between these candles. So if such a thing appears on top of the graph, it signifies a drop in the market for the next day. Dodgy top, abandoned baby, actually they have different names, or they just the examples of the same thing, and the same thing is just an evening star and the morning star, and the other names are just variations, different variations that they use in the markets. So it's just like I told you, yeah, 412 is a morning star, and usually it looks like this. What is also interesting here to look is 414 and 415. These two candle combinations, both two candle combinations look very familiar, look very similar. The difference is that we have a small candle that is black or white, and next comes a full-bodied candle, bigger than this small one, and it sort of eats it completely, engulfs it. And that sort of a thing is called engulfing pattern. Engulfing pattern means someone ate someone, just like a shark eats a small fish, and it's called engulfing pattern in the markets. If the larger, the full-bodied candle is black, that means what? It may mean that next day will be a bearish day, or the next moment is going to be a bearish day and the market is going to go down. If the bigger candle, white candle, comes after a small black candle, the next day is going to be bright for us. The market is going to go up, and it's called bullish engulfing pattern. These candles, the small candle can be a bit larger. It does not mean that it's going to be this small. But the main idea is that the body of the second candle should completely engulf the body of the previous one. And also what is important, the shadows of the previous candle may be longer. So it does not mean that the second candle should engulf the previous candle with shadows. Yeah? Some people think that it really should engulf the previous one with shadows. So eat it completely, so to speak, with shadows. No, it does not have to eat it completely with its stomach and its legs and arms. It may eat it just the body of it. And it is also called engulfing pattern, bearish or bullish. depending on the color of the candle that comes next. Usually a bearish pattern comes again at the lower case of the graph, somewhere in the beginning, at the minimum point of the graph. So usually it comes at the top, just like a hanging man or an evening star. So that means it's somewhere upper on the graph, and if it comes, that means next day will be not very good for us. And the bullish pattern may come usually somewhere closer to the minimum of the chart of the graph. But sometimes it may appear somewhere in between also, because there are exceptions, and you got to understand that the markets is not a mathematical thing. This is not. This is a living organism, so to speak. The market is a living organism, just like a human being. It may catch a cold, it may run a temperature, and all these symbols and specific things which we know of human beings can be replicated and projected onto the financial markets, because they usually develop just like human beings. They run temperature. High temperature means the markets are driving too fast and too quickly, and they overheat. And when they overheat, there comes this hanging man or an evening star, and this is the end of it. There will be a drop or a crash in the market. Also, a good thing, a good candle combination, dark cloud cover. A dark cloud cover looks very much like bearish engulfing pattern, yeah? It is very similar. The difference is that the black candle should engulf the white candle by more than by half. If it consumes it by half, here it's longer, yeah. Here it engulfs 3/4, over 3/4, some 80% of it in this example, and still the same result. It's called dark cloud cover. But in the textbook, it says, the classical Japanese candlestick analysis says that it should engulf the previous candle, the white one, by half, and it's enough to call it dark cloud cover. Where does it appear? Usually it appears on the same location where before we've seen evening star. And actually that's why it's called dark cloud, dark cloud cover. It's a sort of a eclipse when you do not see anything, when the day went black. At the height of the day, after a heating sun, you see this eclipse, and everything goes dark, and that means the market is also going to go down. Dark cloud cover. And if we have the reverse situation, it's called piercing pattern, and it also should engulf only 15%. This is enough. If the white candle engulfs the black one from lowercase graph, the half of the black one, that would mean piercing pattern, and it appears on the same location where usually we had a morning star or abandoned baby, or a hammer. Usually it comes there, at the bottom of the graph, and it's called a piercing pattern. Harami, the very Japanese word. It's a reverse thing to engulfing pattern. Yeah, usually it is a very small candle that goes after a big one. They can change colors. It does not mean that it appears always in this combination, white and black. It can be black and white. But the main idea is that the next candle, the second one, should be consumed by the previous one. Usually in the engulfing patterns we consume the previous one, but here in this particular case, the previous one consumes the candle that comes after. So it should have a very small body, and it should be somewhere in between of the full-bodied candle before this. If we have a black candle, if the second candle is black, this combination is called bearish harami. Yeah, bearish harami. If we have the reverse situation, if first comes black and then comes white, that means bullish harami. And they have the same meaning. Bullish means that it may be a symbol, a message for next day's rise in the market, and bearish harami would mean the reverse situation. The market may go down. The variation of these candle combinations would be bearish harami cross and bullish harami cross. They are the same. Well, some people say, some traders say that they are just more more impressive or more expressive about the markets, these bearish harami cross. And sometimes this cross is called, from the previous candle names, a dragonfly. This is also called a dragonfly in this particular example, with this bearish harami cross and the bullish harami cross. This is a very interesting thing. Also, 3 candle combinations. It's like a ladder. 2 ladders. You see these 2 ladders. One of the ladders goes up and up and up, and the other one goes down, down, down. The one that goes down, that descends, the ladder that descends is called 3 crows, sometimes also called 3 black crows. But because crows are usually black, it is really difficult to find a white crow. And usually they are black, so we do not have to say 3 black crows, just 3 crows, because they're usually black in nature. And the ascending ladder would be called 3 white soldiers. The main characteristic of these candles is that these 3 candles should have almost the same size. For example, if they are very different, and you've got 3 candles, and one is very small, the other is a bit bigger, and the third one is way too much big, it's not going to be called 3 white soldiers. And the same thing is not true about the black candles. So they should be big enough to be called these candle combinations, almost equal. If you've got several white candles of different sizes, and they're also going up and up and up, but they have different sizes. The one is small, the other is big, the next one is smaller, also small. This combination would be called stalled pattern. Stalled means that the market, it's as if someone put a brake on the market. It's the same, it has the same meaning. You put a brake, like in a car, for example. You stop. In order to stop a car, you got to press the brake pedal in order to stop the car. And that's why it's called a stalled pattern. That means the market is going to stop. So it's going to quickly, and you see that it exhausts its powers. Actually, the size of these candles, smaller and smaller candles, means that market exhausts its powers. It exhausts it so much that actually no further drive will be possible. It loses its strength. There are many other candle combinations, for example, bearish falling 3, bullish rising 3. They are very rare. It is a very rare thing to find in the markets, in the candlestick analysis. Personally, I did not find such candle combinations, but some books have these sorts of candle combinations. And these are examples, yeah? Shooting star. Shooting star is the same thing like I told you, falling star. They have the same name. Shooting star appears at the top and the market goes down. But here the market goes down, yeah? We see what comes next. What is this candle combination that comes next? It's called bullish harami, because a smaller candle is sort of inside the black bearish one. And the market goes up. But then you've got bearish engulfing pattern. You see? Bearish engulfing pattern. The black one consumes completely the white one. However, you see that it does not completely consume the shadow, the upper shadow of the previous one. So this is what I was talking to you about. Yeah, this is what I was telling you, that it does not have to consume the shadows. It should consume really the body. And you see these two strong signs, a falling star, a shooting star, a comet coming down on Earth from somewhere, from another galaxy, some sort of a meteorite. It's falling with the tail spinning behind its head, so to speak. And then you've got a bearish engulfing candle combination, and the market goes down, down, down. It drives down, down, and down. And here you see a candle, like I told you, with no upper shadow, but it is twice as large as its lower shadow. It's a hammer. So it strikes the market, and the market goes up. So this is an example of candlestick analysis. Then you've got other, of course, things. You see here, they call it a hammer, although it does not look like the classical hammer, yeah? So it has a very small upper shadow, you see? It has a very low upper shadow. And the rule says that if this upper shadow is so small that you can neglect it, then you should call it a hammer. So it's just like in nature, twins look very much the same. They look familiar, but they still have their differences. And here, in this particular candlestick analysis, it is also very important to know that there are variations. And you got to look through those variations and find specific symbols behind them. So nothing can be fixed, actually, in this analysis. Usually many things change, and well, but here you've got a very bright, a very notable example of a bullish engulfing pattern. A very large white candle and a black one that is totally consumed by it, together with shadows, with stomach, arms and legs, everything. This is bullish engulfing pattern. What it also says here, it consumes not only the previous one, it consumes 5 previous candles and the real body of the hammer together with it. So it's a very, very strong signal for the market to go up next day, on the next moment. Here you see the candle combination they call shooting star, but it is also can be called what? It's an evening star also. If you find such a candle combination at the top, it does not matter actually whether it's a shooting star or just an evening star. They have the same meaning. An evening star can be also, why it is called shooting star actually? Because the third candle has a very small body, but in our example it had a bigger body. So that's the difference. But still, this is a star combination, and it signifies a particular signal for the market to go down. Then you've got this bearish Harami cross, a very small, almost a doji star. It's a doji star, and you see here the big white candle and bearish Harami cross. What does it mean? It may mean that next would come a drop in the market. And the shooting star formation, or an evening star, also the same thing, would be another example of an evening star. And here you see this December 01, these two candles, what is it actually according to our analysis? This is bullish engulfing pattern. So the white candle consumes the black one and the market starts up. This is bullish engulfing pattern. Here you see also bullish engulfing pattern. You see this example. So the first one looks like a falling star, or a shooting star. And then comes this white candle that consumes it. And everyone expected that next day the market will go up. But it didn't. So in the real sense of the word, here we cannot say that this is engulfing pattern, because it was a sort of a false signal, because markets may send false symbols and true symbols also. It may trick you, so you've decided to buy shares, but actually the market went down. It went down and you could lose your money. However, in a couple of days, the market really recovered. You see, it was a sort of a deterred action of the market. So it tricked you, but still in the end it started to grow. So there are many actually variations and many situations that are very important in the markets and very important to understand. You see here also big gaps, yeah, between the candles. Here you see this sort of gap, and here, in this particular example, it is called the weakness of the market. The market was so weak that it dropped somewhere here, started actually lower. What may happen? Usually something extremely important happens. For example, a wildfire in Australia or in New Zealand. And the market may start the next day with a very low point. This is called the loss of the strength of the market, or just the weakness of the market, that big gap. And actually it happened after bearish engulfing pattern, you see here. So it's as if some of the market felt that next day wildfire is going to happen. Yeah, it's a very interesting thing. The technical analysis may show what may come next, but nobody knows what it is, what's going to happen. It may be an explosion at a nuclear reactor, nuclear power station, Fukushima, for instance. It may be a wildfire, it may be a great flood, it may be anything. Maybe someone shoot the president, or maybe a revolution happened in the United States. They stormed the White House or something. But the market is is so clever that it may feel these events to come. It's as if it feels that something is going to happen. It's just like in December 2019, I still remember the final days of the year 2019, and we sat with a group of investors and we were talking about our future projections for the year 2020. Nobody knew about the pandemics. We did not see or recognize what's going to happen next. It was, I still remember the day, the December the 30th, so just one day before the new year, and we were speculating about what should we expect in January. And the technical analysis showed, when we analyzed several indices like S&P 500, DAX 30, CAC 40, French, German indices, and American indices, we've seen that they all showed decreasing patterns for the year 2020. And you may actually imagine the astonishment when a few months later the market really crashed. That was in just 3 months after that. And well, that was a huge crash, a huge blow to many investors. Lots of people lost their money, complete accounts. They had their portfolios destroyed completely, and they had to start everything from anew or do not start at all. Several brokers went bust. Of course, the big brokers did not go bust, like Sberbank or Tinkoff. They stayed afloat, but I think they still had some difficulties with paying out these obligations to their clients. But in the end, that was a very difficult thing, very dangerous thing to have happened here. Now, here you've got a very bright example of a bullish arami. Yeah. So a very large black candle and a very small candle. And also, what comes next? 3 white soldiers. 3 white candles that look almost the same. And they ascend. The next is higher than the previous one. But you see that we see these candles, they become of different size. They are of different sizes. That means the market loses its strength. And there was this final explosion, so to speak, and here comes what? Bearish engulfing pattern, and the market goes down with this bearish engulfing pattern again. So here, after this bullish Arami, you should have bought, and here, after the bearish engulfing pattern, you should have closed your position and exit the market. Variation of a morning star formation. Variation, well, it appears here at the bottom of the graph of the chart, and the market goes up. 3 white soldiers again. The market loses its strength. Shooting star, a falling star, and the market sort of, it does not drop really, yeah, but it stalls. It stops growing. And then there is this final explosion, so to speak, but very weak. Very, very weak, because the market really started going up too quickly. It was very rush in its going up, and the size of the candles, they become smaller and smaller and smaller. This is actually called the situation when the stalled pattern, when the market loses its strength, and you see here bearish Arami cross, and it goes down. Bullish piercing pattern, yeah, the example of the bullish piercing pattern. The white candle consumes more than half of the black one. It consumes actually 60 or 70% of it, but 50% I told you is enough to call it piercing pattern. Rickshaw doji, a candle with, here actually we cannot say that they're equal. The upper and lower shadows are not equal, but it's just like with any other candle combinations. Everything is, Albert Einstein said, everything is relative. You should not really think in absolute terms. You should not take it too seriously to your hearts. That this is just the rule and you should stick to it. It's not mathematics. It's a very sensitive thing, very logical, and verbal. Verbal, that's language, the financial language of the market. And also very important to say that Japanese candlestick analysis explains 30% of market situations. So that means 70% of other situations lay somewhere beyond the understanding of this particular market. It's just like in philosophy, you've got transcendent and transcendental things. The things human beings may understand, are able to understand. Transcendental things we may understand, but transcendent things we cannot understand. We cannot look through them, and this is what this candlestick analysis is about, actually. It explains 30% of things, but no more. Well, other examples really look much the same. Also, what I would like to show is a sort of a platform to trade. Actually, in order to start to trade, there are many brokers. It does not mean that you should go to Alpha Bank or Absolute Bank or HSBC. This is not an advertisement. It's just MetaTrader 5 is a universal thing. It's just like Windows. Just like Windows or OS, Apple operating system, or Android operating system. MetaTrader 5 is just a program to run your brokerage accounts. 5 means this is the latest version of it. There were MetaTrader 4, 3, 2, and just simple MetaTrader. It started somewhere 20 years ago, something when internet really skyrocketed. Today we have the latest version of it. It's called MetaTrader 5. You register there. For example, this morning I could not download this program here on this computer because it shows this administrative thing telling you that you cannot install it before you enter the password. But what I could do here, even on this computer, this is not my personal computer, I just registered with this MQL5, it's called MQL5. I registered with my Facebook account, and I see here my sort of demo account. It is not really linked to any brokerage, so it may be any brokerage, but this is how it looks in reality. This MetaTrader 5 terminal. For example, you decided for Tinkoff, and you have created a trading account, and you may use this platform. You just you should really find an account here. It is called, this function is called switch onto a trading account, something of the sort. You click on it, you put here your login and the password. You also may choose MetaTrader 5 or MetaTrader 4 if it's more understandable to you. Yeah, this is this thing. And also you may create any other account with another broker, with Sberbank or VTB or something of the sort. You've created your account and you come here and use these passwords, use these numbers, accounts. You switch onto this account and it's going to work. So this is a universal thing, just like Windows or Office package. It's a universal thing. I have created a demo account here, and what I would like to show you, it's actually the same thing we've seen where? On investing.com. The difference is that investing.com does not allow you to do what? To strike a deal. Yeah, you cannot buy or sell there. But here it is possible. In order to buy or sell, you just do what? Actually, the market should work. Today it doesn't work, so we cannot buy and sell anything. We cannot just click on it. We can click actually, but it will say that the market is closed. You cannot strike a deal before something happens. So this is a very important thing. You may do this. For example, you feel or you've conducted technical analysis, Japanese candlestick analysis, and you're sure that the market is going to go up or down on Monday. And you've decided on Saturday to open a deal. No, it's not going to happen. So you will have to wait until Monday morning when the market's going to be opened. And then you strike a deal. You buy or sell, and you will see what's going to happen after that. Also, a very good thing to learn from the markets. You see here combinations of some symbols. We see here our we already know it. This is gold versus US dollar. We usually analyze this market, the gold market. XAUUSD daily. The current price, so the market closed yesterday. The market closed yesterday, the gold market closed yesterday, October the 1st, at $1,760.15. That was the price of gold yesterday. Then on Monday, the price will be different, of course. And you will sell or buy something. Bid or ask, what is it? Bid, that means this is the price, just like in a bank. They always have this exchange rate, bid and ask. And the difference between them is called the spread. This is the sort of a hedging thing. The banks or brokers would like to hedge their positions. So they cannot sell or buy the same good, the same asset at the same price. If it were the case, then we would be very clever, and it would be very easy to trade, actually. But this spread actually is a very good instrument to hedge the positions. Also, here sometimes maybe I cannot show it. Columns. Columns means I can show here the spread also between these two prices. So now I've got only 3 columns: symbol, an asset or an instrument, bid and ask, but I also can add here one more column, which is spread. What does it say, this spread? It is a very, very important thing. Before you open a deal to use some sort of an asset, a sort of an instrument, you got to look at this particular column. Why? Because it's going to tell you how much your broker is going to charge you if you open a deal with that sort of instrument. And what is the best thing to do is to open positions. What positions? The cheapest. With cheapest brokerage fees. If, for example, you see USD versus ruble, 1,000. If you buy a lot of this instrument, just a lot of it, you will have to pay $1,000 at the moment you open this deal. You understand that this is very risky. But for example, if you buy a lot of gold, you will have to pay only $24. The same goes for other assets. Like I told you, you remember I told you that the cheapest asset to buy, the cheapest instrument, is Australian dollar. Here in this particular case, the cheapest would be Australian dollar, Japanese yen, and euro. But I also told you that during the day, these spreads may what? They may change. For example, euro would cost 25, Australian dollar will go down to 7 or 6 dollars a lot, and so on. USD, SEK, Swedish krona, also a very expensive thing to trade. $260 if you buy a lot of it. So it is advisable to trade only in assets that have the smallest charges, fees behind them. It's a very good idea. If I add here palladium, for instance, palladium, let's see how much it costs. Palladium versus US dollar. 27,980 bucks. So that's why I told you that is a very risky asset trade. It is a very volatile asset. You may profit very much from it, but you got to be really a professional trader to do that. Only professionals enter that specific market. Let's see what Bitcoin. What about the Bitcoin? BTC. Bitcoin, yuan, Bitcoin euro, Bitcoin yen, Bitcoin US dollar. Well, $6,000. But still, actually, it's a very large sum of money. Very great amount of money. And it may change also. Before the pandemics, the highest spread for palladium was $6,000. The pandemics changed many things. It changed the demand pattern for it. It changed the supply pattern. Chips became too difficult and expensive to produce, and many companies use palladium to produce very complicated things, cheap for cars, car chips and things such as these. That is very, very important thing. So we do not trade in the markets that are very expensive. That's a rule for you to understand. Also, we've got Fibonacci lines here, just like any other instrument. You may construct it. It's going to be this Fibonacci line. This is the same thing actually, like it's more convenient, I should say. It is way more convenient than investing.com. It works really good. You see here everything. Also, what investing.com does not show is the number of basis points the market goes up or down. What is basis points? A basis point is just a measure of the movement of the market. And here, if you choose this cross and you put it somewhere here in order to see what was the market's movement, you see the figure that comes. You see here three numbers: 14, 13,672, and 1,698. Three figures. You see. 14 means what? 14, this is period of 14 days, because it's a daily chart. 14 days. Why aren't there enough candles? You cannot number 14 candles in here. Why? That means there were Sundays, Saturdays, right? Maybe even national holidays. So that's why no 14 candles, but 14 days passed, half a month. The figure that comes in between is the number of points. You see, 13,000 or 14, let's just make it a round number, 14,000 points. What does it mean? 14,000 points. It means if you open a position to sell here, yeah, and close your position down here, and if you sold one lot of gold, you would gain by this time $15,000. If you close your position here and open another one and go up again, and the market grows up again here, you would also gain $15,000 if you buy one lot of gold. So this is a very good instrument to use. Investing.com does not allow you to calculate your profits, right? You will have to just compare the prices, just like we did it last Saturday. We just, what did we do? We just reduced the we contracted one number from the other to see how much we gained. But here, everything is done for you, just like WinWord or Excel. It usually does everything you wish with anything you would like to do. It constructs horizontal lines, it constructs vertical lines. Why do we need vertical lines on these graphs? It shows date and time. So that means you may actually start trying to construct a sort of a prognosis for what is going to come next, to see what's going to happen. Yeah. What is going to happen on Monday? Is it going to go down or is it going to go up? We will have to conduct the technical analysis to see MACD, convergence, divergence. How can we find this divergence, convergence? We should really find indicators. Indicators, yeah? And you see here a number of choices. Accelerator, oscillator, accumulation, alligator, trend oscillators. Our moving average here is called trend indicator. Moving average here in this particular case is called a trend indicator. Moving average. We usually use 20 and 50 period moving averages, right? And usually it's going to be blue. How do I do this? Well, maybe after it is constructed. Yeah, it is red, but I really needed blue. How do I do this? Actually, interesting. What about 50? If I would like to add the 50 moving average, what's going to become of it? Is it going to be the same? This is not a very good thing. They should be different. Two moving averages cannot be of the same color. Well, actually, we'll have to see about that later, how it's done. Close, usually we apply this moving average to the closing price. That's why here it's called close. It can be simple, exponential, smooth, linear. Well, actually, we just use the simple moving average, show it in all time frames, whether it's 1 minute, 50, 5 minutes, 15, 1 hour, a day, parameters. Okay, maybe we will discover it later on, how to color them different colors. Here you change time frames: 1 minute, 5 minutes, 15 minutes, 30, an hour, 4 hours, daily, week, month. So it looks the same to us. And also we used last time, what did we use? We used oscillator MACD. Moving average, convergence, divergence. And it comes in here. This is moving average, convergence, divergence. And 5 minutes chart. That's how it's going to work. And how do I open a position also? That's the final thing I'm going to tell you in this lecture. In order to buy something or sell something, you should create a new order. A new order. And this is a form. It's just like a, I don't know, it's just like a receipt or a check where you write the price at which you buy or sell. You may choose immediate order. What does it mean? It's going to be opened right at the moment you click on it. And you may choose a deterred order. It's going to work only after a specific moment, when the price touches a specific level. For example, you conduct a technical analysis on Sunday for Monday, what to do. And you think that the price is going to reach a specific level. And you, in the morning, you open your position with deterred order. And if the market touches that particular price you have set, your position is going to work. For example, you go to work and you have no ability to open your position, and it will be only in an hour's time before you come here to the university or to your office, something of the sort. It will do this thing for you automatically. You have usually 4 types of deterred orders. Also, it is very important to learn. Buy limit, sell limit, buy stop, and sell stop. What is the difference between these things? If the price so actually I will have to show it on the example, I think. On the example, you can say something. Okay, for example, in here, I would like to buy or sell. Here actually these are buttons for immediate operations. You just click here or here. These figures, what do they say? The amount of lots. 0.01 is the smallest lot I can buy or sell. And you buy or sell. This is going to be the price you sell, and this is going to be the price you buy at. Then you buy limit or sell limit, or buy and sell limit, buy and sell stop. If the current price is going to be here, somewhere here, 1760, if you expect the price to go up, you open buy limit. If you expect the price to go down, that means you sell limit. And actually, this is way how it works. If you open a position differently, your deal is not going to work. And also, what is very important here with these orders is putting stop losses and take profits. What is a stop loss? It's just like I told you. If this is an automatic thing, yeah? For example, you would not like to wait, or you cannot wait for the market to move. You cannot watch it, monitor it all the time. You got to go to hospital, to your work, you will be not available. You would like to sleep in the end. Yeah? You put here stop loss. What does it mean? Stop loss. Actually, it's the line. This is the line that goes somewhere down lower. Yeah? And this is a sort of a limit. If the price is going to break that particular limit, the position will close automatically. And you will have not to wait until the market does something. It will automatically close your losses. You understand? Or it's a sort of an optimization mechanism. Because people usually, what do they do usually when they see these market going up and down? They still hope that something will change in their favor. This is a mistake. Never do this. If you put this stop loss automatically, it will close automatically and you will have no time actually to think or hope. Because computer has no senses, has no nerves, just unlike people. And this is a very good instrument. You see that, how do you put those stop losses? You conduct technical analysis, moving averages, yeah, and you see where this candle, if this candle breaks away at some point, somewhere a red candle going from the moving average, yeah, you put there this stop loss because you feel like this is the absolute limit and beyond which I am not allowed to go because I will lose my my account completely, and there I put it. Just like a finishing line for you. Just like a finishing line before you stop. And it saves you this way. It saves your money, it saves your nerves. But actually, sometimes what usually happens? The market really may change its direction. And you will be very disappointed that you have put this stop loss. This is also a very dangerous thing for some people and a very unfortunate thing. So where you could have waited, you did not wait, or the computer did not wait, it did it instead of yourself, and that was it. Thank you very much.